Today's discussion is a continuation from the last few weeks, where we began to differentiate between the owner-operator, strategic, and financial buyers. The focus here is going to be on some of the nuances and considerations of selling to a strategic buyer. Typically, when we refer to this cohort, we're referencing a company that's already in the industry or on the periphery. Strategic buyers are often looking at what additional revenue can be generated from combining the two companies. This doesn't refer to the 1 + 1 = 2 scenario, but rather the ability to see incremental growth from cross-selling their product and services from one company into the other's customer base. A big consideration is also the ability to cut costs. Low-hanging fruit is often in the accounting and HR departments, duplicate software licenses, and in some instances, office leases. Now, this doesn't mean that the standalone entity can't be extremely attractive as well. In these instances, buyers may be looking at expanding into a new geography, acquiring talent, or perhaps acquiring customers and revenue at a cheaper cost of acquisition than traditional marketing methods. There are some key considerations when selling to a strategic buyer. First are the company's wages. An owner may command higher margins because the employees are loyal to them, and they're willing to work at a lower wage than possible in the open market. Upon a change of ownership, the possibility to shop their services may lead to the reality that they can get much better compensation, thus leading to a loss of talent or higher labor costs and lower income for the acquirer. A similar issue arises with companies' pricing. A company underpricing its services may have legacy customers, but they may not fit into the model of the acquirer. Of course, price increases at the close have a higher probability of causing customer churn. Recognizing this, a company looking to sell to a strategic buyer needs to have a really strong understanding of the key industry metrics like pricing, margins, and any other KPI or key performance indicator that are relevant to your industry. You're going to be in a much stronger position to sell at the best price and terms should your metrics match or exceed the industry norm. Keep in mind that strategic buyers are typically better capitalized, discerning, and they know where the bodies are buried in your industry. So they're likely to do deeper diligence and have tighter purchase agreements. This means that you need to have much tighter financial and operational controls in order to pass muster and reach the finish line in a deal. An agreement could include stricter reps and warranties, longer transition periods, and include compensation tied to customer retention. In summary, strategic buyers are a great area to focus when a company has potential revenue and cost synergies. A great team. The owner isn't quite ready to retire, or the owner wants to participate in the future upside of the business. Strategic buyers may not be the best fit when industry metrics are out of line. The business is too small to return an investment after paying the former owner or a manager to replace them, or if the business has challenges that an industry insider would discount considerably. We're going to wrap up this topic next time with a discussion on the financial buyer.